can we understand in depth what do you mean by detections and how it can happen, so that you can be able to go, once you go back, you can be able to detect those suspicious transactions.
Detection is very key in getting Kenya out of the grey list, and we saw yesterday the implications of being on the grey list. Even in terms of doing transactions, it becomes more difficult, and even more greater than that is the reputation of Kenya once you're in the grey list. So we must all work together to come out of the grey list. The demo has taken you through the basic foundations you need to do even before you can begin doing detection. You need to understand your customers, you need to understand your risk appetite, you need to do the institutional risk assessments so that you can be able to know this customer is not behaving in the way that we agreed, and be able to detect the suspicious transactions. We shall look at how you can detect the suspicions. We categorize them in 3 ways. We have KYC indicators, know your customer. This is where the customer varies in terms of how you recorded their KYC details versus who they actually are. We have the transactional indicators. This one is to detect as you interact with the customer, the way they're conducting their transactions. The KYC is okay, but there are some flags in this area. Then we have the behavioral indicators that result in filing something called an SAR. Did we talk about the distinction between SDR and SAR? We shall do that. Behavior is on the behavior of the customer. The KYC is okay, transactions is okay, but the behavior has some suspicious elements. We shall look at elements of a suspicious transaction report. What is the bare minimum you must give the FRC? We shall look at something called defensive filing. Yes, you have filed an STR, but for us, it's not valuable. It's just adding numbers to our database. We shall look at the overview statistics of reporting of the insurance sectors, not only lumped up, but we shall break it down granular to the insurance companies, the intermediaries, and so forth. We see who is reporting where. We shall look at deficiencies in filed reports, what you have already filed, what are the areas of improvement, record keeping, and something we call terrorism financing. Should you be concerned? Have insurance companies been entangled in this web? And penalties. In case you decide you won't report, you decide that is a job of the underwriters, me I'm an intermediary, mini broker, I won't report. What does the law say or prescribe for failure to report? What must be reported? All suspicious transactions, including attempted transactions.
The mafias usually say, if you are lucky to stumble on mega money, maintain your old lifestyle. If you can't maintain your old lifestyle, maintain a low profile. Because camouflage and concealment are not only for the war front. Shine is one reason things are seen. That's why one of the persons, my brother seated there yesterday, asked the question, why are you guys not coming for these guys who are parading that they have bought a Porsche Cayenne and a house in Ruda or Lavington in social media? I can tell you, those are amateur money launderers. If you see somebody who is parading his product TX, which is only worth 5.2, that's just an amateur. The serious guys never say it. They know how to maintain the old lifestyle, and they know how to camouflage. Yes. Those are just amateurs, brother.
Most of these policies, the first year, the agent earns very good commission. There are those policies where the agent can even earn 40%. So if that is why I think you also mentioned that we need to do a 360 degrees, because maybe the agent, if it was the agent who brought the business, maybe it was part of that. If you do 40% that was paid to the agent, and maybe the agent gave back money to this person, and then surrender value is 50%. If you do the math, this person lost only 10% and have cleaned the 3 point something worth of transaction. So I think it is also important that when we have such suspicious transactions, we do a 360 as you mentioned. Thank you.
Thank you. He has given us another angle to this suspicion. Do you see how suspicion can further? One suspicion can lead to another, can lead to another. I had not even thought of that. What if this individual is colluding with the agent?
So you need to know what business is this lawyer in our book engaged in. The NRMA has just classified generally, but as you may say, the ones you have in your books, or the customer who has come to you, what kind of activities is this lawyer involved in? So if that lawyer is not involved in the activities indicated in the law, then you don't have to say this particular lawyer poses a high ML risk. So you need to understand who is this person whom I'm dealing with. What activities is this person engaged in? So that we're able now to properly profile the customer and apply the necessary customer due diligence measures.
And now we look at transactional red flags. Again, this is where you get a lot of the STRs. We have the unusual transaction patterns, whereby the customer keeps on altering their mode of operation. The endowment fund, they have been contributing 10,000 every month. All of a sudden, it has increased to 20, 30, 40, 50, and you notice it is a pattern. It is deliberate to try and avoid suspicion, but all the same, this person looks like they have more money, which they're trying to inject into the insurance company. We look at structuring and how it can happen, how they can determine this is your threshold, but they just split that money amongst various products. A rapid movement of funds, uptake of a policy, and then within, it's called a free look period. They cancel and they require a refund. Inconsistent business activities. You cannot tell exactly what this client does. They're in a cash-intensive business, but you cannot tell the source of these funds. Unexplained third-party relationships. The funds funding the premium, they're not coming from the client whom you have done KYC on. Other people are doing deposits to the bank account of the insurance entity. Why would 10 people, random people, be depositing money to pay for premiums for the one person whom you have done KYC for? That is again another red flag which can lead to you doing due diligence. Not reporting automatically, but you conduct due diligence. We have customers who usually purchase small policies and then all of a sudden they request a lump sum contract. So this person, initially they could have taken the lump sum, but they split it into small policies. Then they request that you aggregate it into one lump sum one. So they're trying to bypass controls. They know that small policies have got lower KYC thresholds. And then when they try and aggregate it, they will have actually managed to put a lot of money into the insurance entity.
What about the transaction premiums paid for a banker's check?
If we are still sticking to the analogy of the teacher and the CEO, if the teacher says that at the onset, or as they fill in the proposal form, that their source of funds will be the salary paid by their employer, then we would expect that at the very least that we are setting up a check-off, payment arrangement with the employer, so that then we are comfortable. If this person insists that the source of funds to be used to fund the policy is from the employer, and then they don't want to set that, but they don't want to set up a check-off, then immediately there is a red flag. Then you need to conduct further tests. The first installment of the premium can be considered, but the subsequent ones, we should be able to see that coming from them, or that we should be able to see a congruence between what is given as the information and how the actual transactions are coming in. We usually see other people wanting to consider a banker's check, especially if the source of funds have been indicated as business or self-employment. Then at that point is when you now want to verify that the bank account where the check is being drawn from actually receive funds from proceeds of a business that is existing.
From the bank assurance experience vis-a-vis, by extension, the bank, again, as Thiongo said, you have to know your triggers. You have to know, okay, banker's check, it may seem innocent, but then again, it's to go that step further and say, maybe I need to have some threshold where I say anything that is above this amount, even though, and I think I speak specifically for where we may wrongly derive comfort that, this is a bank customer, so therefore, they have already been monitored through the normal banking monitoring processes. So I think it's just to go that additional step and say, if I'm seeing this as a trigger on the insurance side and this is a bank customer, then I treat this as a trigger event for me now to still do an independent monitoring and verification of this, down the road. He has given me a banker's check, or he has given me, it's a direct debit from an account, but let us see how that activity in the account looks like, over a period of time, just to give us comfort that it is above board.
We need to note that regardless of the channel that someone is paying through, there would be a risk. A banker's check might have been gotten from a branch that the one who is bringing is able to compromise the staff. So I think it is upon us to make sure that regardless of the manner in which the monies come to us, we do the KYCs and AML. We make sure that the transaction is monitored so that we don't become a conduit of completing a transaction whereby at some point someone was compromised.
We know that bankers' checks can be issued in two ways. It can be issued from a customer's account or by the bank itself. So from an insurance perspective, when you are determining the source of funds, because I think that's what we are doing, aren't we not getting ourselves into some sort of headwinds? Because maybe the document that would satiate sources of funds could be an extract of a bank statement from the customer, or having to call back. What basically it means is contacting that particular institution, confirming whether they issued that banker's check.
If you look at the process of issuing of banker's checks, there are usually two levels. Number one, you can go to the bank, move money from your account, do a transfer, and get a banker's check. I already have an account. At that level, the assumption is by the time the money was coming in the account, the bank had done its own due diligence. Number two, I come with money and I'm not a member of this bank, is it? Some banks will tell you you need to open an account. Some banks will process a banker's check for you, is it? But how much information does the bank have on me when I'm not their customer? Huh? Not much, is it? And remember, in this scenario here, that's why I had drawn here. This money comes from the customer. The customer's account, a banker's check goes direct, is it? This other one, this guy comes in cash, is it? He is not known to the bank, is it? The bank knows, say, Britam Insurance, for example, is it? So the client is Britam. You are just an agent in that account or just somebody doing a transaction, is it? You are third party. So Britam, the KCB will be having very little information on this customer, is it? Regulation 32 of POCAMLA. Where you are using such a relationship, this person is collecting money on your behalf, the ultimate responsibility still falls with you because he's your customer. That's why he is saying he don't want to vote for all the banks because even banks have their problems. Yeah? Somebody might have been compromised, is it? It is up to you to ensure the due diligence you do on this customer is valid. If you are comfortable with whatever they have done, well and good. If you are not 100% sure, do whatever he has told you. You still have to do your due diligence.